Hello, everyone. Welcome back to our channel. Today we'll guide you to share or stock buybacks. Let's get started. In simple terms, stock buybacks are when a company buys back its own shares, either from the market or directly from shareholders. It's a popular move in corporate finance, often used to boost the company's financial standing and benefit shareholders. In this video, we'll break down what stock buybacks are, the types, why companies do them, and the pros and cons. Understanding this can help you make smarter investment choices. First off, let's talk about what are stock buybacks. Stock buybacks, or share repurchases, happen when a company buys its own shares from the market. This can impact stock price, earnings per share or EPS, and market perception. Companies use buybacks to return value to shareholders, boost stock prices, or show financial confidence. The repurchased shares can be retired or kept as treasury shares, reducing the total shares in circulation and increasing the value of each remaining share. Next, let's look at types of stock buybacks. There are a few different ways companies can do stock buybacks. First, open market purchases. This is the most common method, where the company buys shares slowly from the market, like any regular investor, to avoid big price jumps. Second, tender offers. The company makes an offer to buy a certain number of shares at a price higher than the market, and shareholders can choose to sell their shares at that price. Next, Dutch auction. The company sets a price range, and shareholders bid on how many shares they're willing to sell and at what price. The company picks the lowest price that meets their buyback goal. And the last, direct negotiation. Sometimes, companies deal directly with large shareholders or institutions to buy big chunks of shares. It's not as common, but it happens. Knowing these methods helps investors understand why companies choose certain buyback strategies. Let's move on to the reason why companies buy back their stock. Companies buy back their shares for several strategic reasons. First, instead of paying dividends, buybacks offer a flexible way to return money without committing to regular payouts. Second, fewer shares increase EPS, making the company look more profitable and appealing to investors. Third, buybacks can raise the stock price, especially when demand is low or prices are falling, helping maintain investor confidence. Fourth, with fewer shares, metrics like return on equity or ROE and EPS improve, making the company look financially stronger. And the last, buybacks show management believes the stock is undervalued and is confident in the company's future, attracting more investors. After learning about the meaning and different types of stock buybacks, let's move on to the pros and cons of stock buybacks. Now, begin with the pros. First, buyback stocks increase potential shareholder capital gains. Second, it can also reduce the number of shares while increasing EPS. Next, it offers higher tax efficiency for shareholders than dividends. Lastly, buyback stock enhances the company's confidence in its undervalued stock and financial health. Next, let's see the cons. First, this method could lead to excessive spending on buybacks instead of investing in growth opportunities. It also emphasizes short-term stock price increases over long-term business health. Next, it involves market perception by considering frequent repurchases as signs of stability, which reflects the lack of higher investing abilities. Lastly, buyback stocks decrease cash reserves by potentially impacting future investments. Stock buybacks help companies boost share value, increase EPS, and improve financial ratios, while showing confidence in their future. They offer a tax-efficient way to return capital but can also lead to issues like misuse of funds and reduced cash reserves. Knowing these effects helps investors evaluate a company's strategic choices and shareholder value. After watching this video, we hope you understand stock buybacks, which have both the pros and cons that you should know about. They can enhance the company's financial position and benefit shareholders. Do not forget to like, share, and subscribe our channel on YouTube or follows our social media below for more insightful content. And see you in the next video.